Okay, hi there everybody. So this is the exercise for management accounting for planning and control. So this is the activity we're working on just now. So it's the variances activity where we've got two products for this company, Abbey and Lee. There's budgeted data here that shows how much they anticipate to produce. Then there's the actual data that they actually produce. And there's some information going along about the labour costs and fixed overheads and things. So you should take some time to familiarise yourself just with the layout with the question, what each thing means. And what we're asked to do in this activity is calculate the following variances. So sales margin variance, contribution variance, material variances, labour variances and fixed overhead variances. So a whole whack of calculations coming down the track for us. Then we want to reconcile the budgeted profit to the actual profit using either absorption or marginal costing. Another thing we're given in this, another thing you're given in the assessment is the variances. So these are all the variances that you're given, and these are all the ones you've got to calculate. So you've chosen to do accounting, so anticipate lots of sums, so hope you like a little bit of maths. I've put the question here in this Excel spreadsheet, so usually it wouldn't be in an Excel. Usually you're just going to get a Word document over, but I've put it here just to show where I'm getting the numbers from. And what I'll do in this video is I'll calculate the first two variances. So I'll show how to calculate the sales margin and sales contribution variances. Then I'll make another one for material and labour and fixed overheads. So we remember here from the variances, the sales margin variances, we get A, B, C and D. We've got the volume variance, mix variance and the price variance. So the first one, A, is standard quantity times standard mix times standard profit, and B is the actual quantity times standard mix times standard profit. C is actual quantity times actual mix times standard profit, and D is actual quantity times actual mix times actual profit. Again, you don't need to memorize these because this will be given to you. So what we do is we set up the standard quantity, standard mix and standard profit. So we set this up ready to be calculated, and there's two products, Abbey and Lee. So we make calculations for Abbey, and we make calculations for Lee. We add them together and that gives us A. So the standard quantity is the total quantity that's budgeted to be produced. So that's the total units of Abbey and the total units of Lee. So we see there's 7,000 units budgeted for Abbey and 9,000 units budgeted for Lee. So the standard quantity expected to be produced is 7,000 plus 9,000 is 16,000 units. So the standard quantities are 16,000. We then want to get the standard mix. So that's just the proportion of each product that's being used out of the 16,000. So for Abbey, it will be 7,000 as a percentage of 16,000, which is 0.438 to 3 decimal places. And for Lee, it will be 9,000 over 16,000, which gives us 0.563 thereabouts. So we plug these numbers in here, the standard quantity, the standard mix, and we'll then get the standard profit. So the standard profit, I think it's given to us in the question here. If it wasn't though, we can see the standard profit will be the selling price, the budgeted selling price. Remember, this is budgeted data. So it'll be the budgeted selling price take away the total cost. So for Abbey, it'll be 100 take away 15, and for Lee, it'll be 95 take away 75. So that gives us a standard profit per unit of £15 for Abbey and £20 for Lee. So we put these numbers in here. Then we do the standard quantity times the standard mix times the standard profit. So we multiply these three together to get the value of A for Abbey. We multiply these together to get the value of A for Lee. We then add together the total value for Abbey and the total value for Lee, and that gives us A, which is £285,000. We're then going to see for B is going to be actual quantity times standard mix times standard profit. So standard mix and standard profit are the same as they were before. So we can just take these numbers down. What's changed though is the quantity. Now we want the actual quantity that's been produced. So we can see from the question, the actual quantity was 6,950 of Abbey and 9,200 of Lee. So again, we just add these numbers together. We add the 6,950 and the 9,200 to give us 16,150. So we do the 16,150, goes in here. Again, we just multiply through again as standard to get these two numbers. We see that's the calculation there for Abbey. Just fix that. And that's the calculation for Lee. Then we add these together to get B. Then for C, what's changed is the actual mix. And again, we can get the actual mix by seeing by using the actual quantities. So for Abbey, the mix used in Abbey is the actual quantity of Abbey, the 6,950, divided by the total quantity. It's the total actual quantity. So it'll give us 0.430 to 3 decimal places. And then for Lee, it will be the 9,200 divided by the 16,150, which will give us 0.56 or 0.570 to 3 decimal places. So we stick these numbers in here, and again, standard profit just coming down from above. We multiply actual quantity, actual mix, and standard profit to give us this value here. For Abbey, same for Lee. So we get the total for Abbey, total for Lee. We add them together to get C. So the 288,250 is just these two numbers here added together. The last thing we need, we've got actual quantity and actual mix. So again, we take these just from above. Now we need actual profits. So to calculate actual profit for Lee, it's just going to be the selling price, take away the costs. So the costs stay the same as they were when we're calculating the standard profit, but now we use the actual selling price. So again, if you look at the question, the actual selling price was 102 for Abbey and 94 for Lee, where it was anticipated to be 195. So what we do is we take the actual prices, we keep the cost, we'd still use the cost that we'd used previously. So to get the actual profit per unit, it's the actual price, take away the costs. So that would be 102, take away 85 for Abbey, which gives us 17. And then for Lee, it's 94, take away the 75, giving us the 19. So again, we take the 15 there for Abbey, 19 there for Lee. We multiply through to give us these two values. We add them together to get D. Then what we do is we calculate the variances. So the volume variance is A take away B. So it's A minus B for the volume variance. So that's the 285,000 or cell G7. Take away 287,672, which is cell G11. And we take these away. A take away B gives us a 2,672 variance. Notice it's a negative number because B is bigger than A. So when we do A take away B, we're getting a negative. But negative sales variances are going to be favourable because we anticipated selling £285,000 worth, where we actually sold £287,672 worth. So that's obviously £2,672 more than we thought. And if we're making more sales than we anticipated, that's favourable. You can see it's the volume variance. So the only difference here in these numbers is the quantity. So instead of selling 16,000, we sold 16,150. So it's a favourable volume variance. We go through them as just the standard here to get B, C, and D. So for B, the mixed variance is B minus C. These numbers take away one another. We'll look at another video about analysing the variances. For For C, it's C minus D for the sales margin price variance. So again, it's just going to be C take away D. Then for the sales margin overall variance, it's A minus D. So again, they're all negatives. But again, this means that actual sales have been higher than budgeted for. So they're all favourable then. So just remember, for sales, negatives will actually be favourable. So that's the sales margin variances. Next thing then is the contribution variances. These are going to be highly similar to the margin variances. The standard quantity, standard mix, actual quantity and actual mix are going to be just the same. So these numbers here are all going to be the same as these ones here. So we can basically just lift these numbers into this set of workings here. What's different though is the contribution. So instead of looking at profit, we're now looking at contribution. And just remember what contribution is. So contribution is the sales price take away the variable cost. The sales price take away the variable cost per unit. That'll give us the contribution per unit. So contribution is sales take away variable costs. It shows us how much we're going to contribute towards fixed costs before we get profits. So what we need to do then is take off the variable costs. So it's basically the same calculation, except this time we're excluding fixed costs. So we've got the budgeted price and the actual price. And to get the standard contribution, or the budgeted contribution, will be the budgeted cost per unit, take away the variable cost per unit. So I've calculated that 45. And the way I got 45 was just doing the total costs, take away the fixed costs, which will be the same as all the variable costs added together for Abbey. So the contribution for Abbey would be basically 100, take away 9, take away 16, take away 20. Or I can also get the variable cost just by doing the total cost, take away the fixed costs. Either way, it's going to give us 45. So to get the standard contribution will be the standard price of 100, take away the total variable cost of 45, which will give us 55. And similarly for Lee, will be the budgeted price of 95, take away the variable costs of 55, which will give us 40. So the standard contribution per unit is 55 for Abbey and 40 for Lee. So we've basically just changed the numbers here. We've got the same one. Again, it's 16,000.438.55, 16,000.438. Then this time, instead of having profits, we've got contribution here. So we'll plug in the numbers for contribution and we multiply through. We get the total for Abbey, total for Lee, then we add them together to get A. Similarly, for this one, all we've changed is the actual quantity. We just multiply through, add these together to get B. Same this time, we've got the actual mix, we'll just take the numbers down. The only thing different now then for D is going to be the actual mix, the actual quantity, actual mix, then the actual contribution. So to get the actual contribution, it's going to be the actual sales price, take away the total variable costs. So in this case for Abbey, it'll be 102, take away the 45, which will give us 57. And for Lee, it will be the actual price of 94, take away the total variable cost of 55, which will give us 39. So we plug those numbers in, of 55 for Abbey, 39 for Lee. We multiply through, get the total for Abbey, total for Lee, then it gives us D. So we've got then the sales contribution variances. Here we have to calculate them next. To get the volume variance, it will be A take away B, which gives us a favourable, B take away C for the mix variance. The price variance is C take away D, which is the C here, take away D here. Then the overall contribution variance is A take away D, which gives us 9,950. Okay, so that's how to calculate the sales margin variances and sales contribution variances.